We often look at financial freedom as some type of distant concept that only the rich know about. With access to the internet, financial freedom has never been closer. So in this video, I am going to walk you through the 4-step payday routine. Step 1. Track. I know this can sound boring, but even at work, the only way to get better is to continuously improve. The way we continuously improve is by doing something, then doing it better and better again and again. This is how we should treat our finances. For example, if we want to save more next month, you have to assess how much you saved last month. You need to sometimes look back and track your financial journey. Practically, you want to split your expenses into fundamental needs, which include rent, utilities, transportation, and groceries, fun wants, and future savings and investments. A good indicator that I use to see if I'm doing well financially that month is get all my monthly total debt, so my mortgage, bills, groceries, etc. And divide this monthly number by your monthly gross income. This will bring you to your debt-to-income ratio. The goal here is to keep this between 35 to 50%, with 35% being on the good side and 50% being on the higher side. Sometimes we have to make uncomfortable changes to benefit for the big vision. Step 2. Save and repay. Save 1 month of living cost. I have spoken about an emergency fund before, but as I have also said, to eat an elephant, you take one bite at a time. Start off by saving 1 month's living expenses. Once you have saved 1 month, you next want to pay off all high-interest debt. High interest can be classed as any debt you have above 8%. After this step, you really want to focus on building that emergency fund for yourself. The emergency fund will protect you if you have any sudden financial expenses, like losing a job or having to buy a new phone, a new laptop, and renew your car insurance all in the same month. 3. Invest. We hear it all the time, but we still don't do it. At a minimum, 10% of your income should be going towards investments. When I say invest, I am not only talking about investing in the stock market. I also mean investing in yourself. By going to seminars, conferences, networking events, doing coding exercises online, and things of this nature. Any skill that will increase your value or knowledge is equally good, so leadership training at work or mentoring for junior employees. Investing in yourself is a way to feel more confident about your ability and is a massive opportunity to showcase your value. I do have to also say compounding assets are enormous in the investing area. These are financial instruments that produce a passive income for you, such as real estate, stocks, and mutual funds. If you can dedicate 10% of your income to this, you will see the compounding gains continue to pile up as more and more zeros in your bank account. At that point, the only question you will be asking is, why didn't I do this earlier? 4. Manage. As with anything in life, you have to continuously keep an eye on what you are doing. A parent always has one eye on their toddler in fear the toddler may do something they're not supposed to. In the same way, we should be looking at our investments like our babies, always keeping an eye on how our money is moving and monitoring the smaller expenses. Set up a specific time to review your finances and your entire portfolio. I suggest every month. As you get older, you will have to continue to adjust your risk. For example, if you just get married, you may want to have a look at your finances in depth. If you buy a car or a house, you will want to look closely at your finances. So continually adjust and manage to suit your specific situation. Watch this video on the 5 rules of financial education that our schooling system never taught us, but the rich taught their children.